I'm here to tell you why the Vanguard S&P 500 ETF is not your best bet. Stay tuned to discover 3 ETFs that are even better to invest in. Now, when it comes to the Vanguard S&P 500 ETF, or the VOO, it is a very smart way to guarantee your fair share of the stock market return. And of course, the performance has done exceptionally well over the last couple of years with the introduction in the rise of artificial intelligence and also the big demand for the semiconductors. Now, when you start looking at the exchange traded fund, it has a very low expense ratio. It does track the S&P 500 index, which means you do have some diversification. Even looking at Warren Buffett, he has a significant amount of money into that index fund, which means it could be a good buy. Now, overall, a lot of investors might want to look at more of a diversification outside of the S&P 500, and that's what we're going to be looking at today is 3 ETFs kind of outside of that S&P 500, and really the reason why we wanted to look at these. Now, when you start thinking of the S&P 500, it is a weighted index. So when you look at Microsoft, Nvidia, and Apple, that is over 20% of your investment as a whole as of today, which means not a lot of diversification. Even when you start looking at the biggest and the largest 10 to 15 companies within the United States, they are holding a big bulk of what you're holding in that S&P 500 fund. So let's go ahead and get into some of the alternatives. Starting with number 1, which is the Invesco S&P 500 equal weighted fund. Now you'll notice this is an equal weighted fund, so it is built a little bit different than the S&P 500 fund, which means you are still holding all of those large companies. You are holding the 500 largest companies in the United States. The biggest difference from this is it is a equal weighted holding, which is exactly the name of the fund. It really gives you not so much of a really bias and so much of a majority in those Microsoft, those Nvidias. Equal weighted means that between those 500, it is an equal percentage cut among those 500 companies. Now, when we start looking at this, again, it constitutes the S&P 500, but it rebalances every quarter to ensure the weight is never far off. So you're not going to have 20% into those mega large cap stocks. So even if Nvidia rockets 50% in the next 6 months, they are going to reinvest the profits from the underperforming stocks and of course the overperforming stocks to buy more of the index itself. So again, it's kind of interesting to think. And of course, you still get a lot of the growth with those largest companies, but they're selling off the portfolio to rebalance it back to an equal weight within that S&P 500. Now, when you start looking at the equal weight, historically, it has outperformed the cap weight, which is what we see with the VOO, but that hasn't been the case over about the last 10 years. This is because of the performance of the mega stocks. When you start looking at Nvidia, again, when you look at Microsoft, this is the reason why the VOO has outperformed it, is those huge companies. Now, of course, it might cost a little bit more to be in this Invesco fund of a 0.2. The expense ratio, again, a little bit higher, but overall, remember the VOO is a 0.03. This has 497 companies that are in the S&P 500. And of course, not super heavily weighted when you look at Microsoft, Nvidia, and Apple. And despite buying and selling every single quarter, they have never distributed any capital gains to any shareholders at all. So that shouldn't be a concern. Looking at our second one, it is the Vanguard Russell 2000 ETF. Now, funny side note, this is what the financial advisor that I work with said to invest in the Vanguard Russell 2000. This one, again, a little bit different when it comes to the investment, and let's go ahead and break it down. So while the S&P is used as the barometer for the overall index, the total stock market is much larger than those 500 companies that we see in those ETFs. There are over 3,000 stocks available in the market right now, which of course is why when you start looking at something like a Vanguard Total Stock Market Index, which covers everything, the index suffers from the same weight challenges of the S&P 500 or the VOO. What's more is the return with those are practically the same because again, when you think of the Vanguard Total Stock Market, the VTI, they are heavily weighted into those large companies, which is the exact same thing we see with the VOO. So thinking of the Vanguard Russell 2000 ETF, this gives you a lot more exposure behind those top 500 companies, a separate small cap fund that allows you to invest in a lot of the smaller companies. And of course, this tracks the small cap Russell 2000, which has outperformed the S&P 500 for the last 35 years from its inception. So looking starting in 1979 all the way to 2014, it has outperformed the S&P 500 for 35 years. But since 2014, the large caps have absolutely dominated the market in their entirety, outperforming the Russell 2000 in the last, well, essentially last 10 years. The S&P 500 has outperformed the Russell 2000 because, of course, of those mega large caps. Now, there's a lot of indicators and a lot of financial advisors are talking about the small caps could be poised for a really big comeback because, of course, the Russell 2000 ETF offers a very low cost exposure of a 0.1%. So putting it in there and investing in some of those small caps might make sense for you when it comes to the diversification of the portfolio. And the final one we look at is the Avantis US Small Cap ETF. Small cap stocks historically outperform the longer companies over the long run, except with the exception of the last 10 years. This is not looking at the entire small caps. This is only looking at the value small caps that are broken down a little bit further. When we think of Warren Buffett, he always says value investing is the way to really make money. And that is exactly what this tracks and what this focuses on. It looks at small cap value stocks, meaning that small businesses that are often very profitable, companies are more likely to survive if there is any economic downturn, and they are very less susceptible to market fluctuations and interest rate adjustments because they are not debt financing everything. These are a lot of companies with a lot of value that have some really strong budgeting and really strong balance sheets. Well, the small cap growth stocks could be home runs. They're more likely than not to be strikeouts for investors. That's what we've normally seen. But then when you break out small cap value stocks, have consistently outperformed the group as an entirety, which is awesome. Now, of course, one of the best ETFs for this that we talked, the Avantis US Small Cap ETF, the ticker symbol is AVUV. Well, technically it is an actively managed fund. It behaves like a passive managed fund, meaning that the manager selects stocks that they believe really meet the criteria on profitability and the evaluation metrics, and they invest it into 761 stocks, and it aims to outperform the Russell 2000, which it has done incredibly well in outperforming that Russell 2000 with this actively kind of semi-passively managed fund. Now, of course, the expense ratio on this 0.25, which is very cheap when it comes to something that is, fully kind of passive, kind of hands-off, fully passive small cap stock fund. And the management team has a very strong record of incredible performance coming from the Dimensional Fund Advisors Group. So the question is, should you invest $1,000 if you had right now into the Vanguard 500 or the Vanguard S&P 500? Honestly, through dollar cost averaging, I would. Now looking again, kind of thinking of the Vanguard, the VOO, I do hold it. I do hold the VTI as well. When we start looking at some of these mega large caps though, we know this year we have seen a multitude of record highs, which means if you're getting into right now, and I know timing the market is near impossible, is you are buying it on record highs. Even yesterday, was another record high for the S&P 500. Today, it cooled off a little bit. We've seen a little bit of sell-off, but overall, when it comes to big picture in the performance, I really feel like the S&P 500, especially again, with the rise of artificial intelligence and everything we're seeing with semiconductors and technology in general, I don't think it's going away anytime soon. And also looking at the performance over the last 10 years, it has done exceptionally well. Now, of course, there are going to be ups and downs. There are going to be market corrections. We have always seen those through all of time, that there has been some adjustments. But again, when Warren Buffett is putting money into it, when you have a lot of these mega huge investors that are putting a considerable amount of money into these index funds, there's a reason they're doing it. When you look at the last, 30 years of the S&P 500, the performance speaks for itself. And I know past performance not indicative to what we could see in the future, but ultimately, when you start looking at these large companies, they're not going anywhere. They're not going out of business. They're not hurting for money, and they're making a ton of money, even though the ratios are very high when it comes to the price and earnings. But overall, the companies are doing incredibly well in the United States economy. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.